what the market, I think, is trying to say is, no, this economy's okay. And we don't need all this extra monetary stimulus. So that's what I think has got this market worried right now, is that the Fed is going to cut rates a lot when we actually don't need it.
Jim Bianco, president of Bianco Research. It is so great to welcome you back to the show. It has been far too long. We are thrilled to have you back on. It's been about 6 months since we last had you, so way too long. Great to see you as always, Jim.
Thanks for having me.
Of course. Well, you were certainly a friend of this show, and this audience loves having you on. And I feel like a lot's happened in 6 months. There's been a lot of changes, but let's just start again with that big picture, the macro view, where we are today and the framework in which you are looking at the world and the economy. And as you know, Jim, you can take all the time you need to set the table.
So I think the big thing that's happened in the last 6 months is the Fed has cut interest rates. And they cut interest rates by 50 basis points instead of 20. And the reaction in the market, and the reason and the reaction is really, I think, the story. The reason that they cut interest rates was they made a lot of concern about the state of the labor market and the state of the economy. Right after they cut interest rates on September 18th, market-based rates, the 10-year yield and the 2-year yield, rose by the most amount ever after the first rate cut. So if you go back and you look at what did the 10-year yield do from September 18th, October 18th, it went up 55 basis points. What does the 10-year yield typically do after the first rate cut? It goes down. It doesn't go up. Mm-hmm. And not only did it go, there's been other instances where it's gone up, but this one, it's gone up by the most ever. So the question is, what's going on here? Why is it that the Fed cut rates? Everybody wrote stories about this means lower mortgage rates, and this means borrowing costs are going to come down. And they've done exactly the opposite. They've gone up. Yeah. And I think that comes back to the realization that by cutting 50 basis points, the Fed signaled, here's a start with 50, and we're going to cut interest rates a lot. And I think that the market is saying, wait a minute, we don't need that much. You're going to go too far, and you're going to create inflation. And that this economy, it's turning out, is actually a lot better than we think. The labor market is actually a lot better than you thought when you cut rates 50 basis points. And if you're signaling to us, there's going to be hundreds of basis points of cuts coming in the future, that's just going to make the bond market go more inflation. And if you're going to produce more inflation, remember, bonds is a fixed investment. Yeah. I only get a certain amount of money every year in a bond. And if you're going to produce inflation, meaning that that dollar buys me less next year, less the year after that, then I thought, because you're producing more inflation, bonds become more unattractive. Price goes down and the yield goes up. So I've heard a lot of people trying to argue, why are rates going up? Oh, because the economy's doing better and the Fed's not going to cut as much. That's actually not being priced into this market. The number of cuts being priced into this market is still largely the same because they're taking Jay Powell at his word. I'm going to cut rates a lot. And what the market, I think, is trying to say is, no, this economy's okay. And we don't need all this extra monetary stimulus. By the way, I didn't even get to the election.
Yeah.
And whether or not Trump becomes the president, he's leading in the betting markets not by much, but if he becomes president and he's going to slap on tariffs, which is inflationary, he's going to cut regulations and he's going to cut taxes, which would produce faster economic growth. We definitely don't need a lot of rate cuts from the Fed. So that's what I think has got this market worried right now, is that the Fed is going to cut rates a lot when we actually don't need it.
The labor market keeps coming up on this show with different guests with different perspectives. And I do want to double click into that because there was a lot of discussion around the huge downward revision numbers that we got. But I'm kind of sensing maybe you have a different take on what's happening in the labor market. Walk us through what you're paying attention to, what you're focused on as it relates to the labor market.
So I think what everybody's got to maybe have a better appreciation for in the labor market is the population growth of the country's exploded. The population of the country is about 340 million people. It was growing at about 0.2%, in 2020. Now that was depressed because of COVID. It was growing about 0.3% before COVID. Today, it's growing over 1%. Why is the population of the country exploded higher? Because there's 7 to 15 million more migrants in the country than there was 4 years ago. And this is a very touchy political issue that comes up a lot. And by the way, Jay Powell has even acknowledged this in his press conferences. They call it the increase of labor supply. And it's being driven largely by the migrant population in the country. So when you point out that in August, 818,000 jobs were revised out of the labor market, that was reported, or the narrative was, the U.S. economy created 818,000 less jobs. I'm with Goldman Sachs' analysis that they said, wait a minute, it's more like 300,000 less jobs were created. Let me back up. The way they came up with that revision to the payroll report was they looked at tax returns, and they looked at how many people were paying unemployment insurance as part of the withholding in their taxes. And they said it was 818,000 less than the survey of jobs that we did. So they revised it down because of taxes. Goldman said, wait a minute, a lot of people are now in this country without a Social Security number or a work permit. If you don't have one of those two things, you cannot get a job with withholding. You could take an under the table job that you're paid cash. And so they estimated that maybe 300,000 of that was lost jobs via the tax returns. The other 500,000 was people that still are employed. They're just not getting withholding taxes. Now, why is that important? Because they're still getting a paycheck every week, and they're still going to the store every week, and they're still spending money. Mm-hmm. And that's why the consumption numbers, the retail sales numbers have been very strong. Well, where's that coming from? There's a lot more people employed in this country than the official numbers are showing because they're getting paid under the table. Last thought for you on this one. Automatic data processing, ADP. There's 165 million people in the country that have jobs. They process the payrolls of 20 million people. They put out that ADP estimate of the jobs report 2 days before. But one of the interesting statistics they put out is how many people work at companies of less than 20 employees, from 20 to 50 employees, from 50 to 250 onward and onward. And their numbers are showing that since 2020, 42% of people that have gotten a job since 2020 have gotten a job at a company of less than 50 employees. A quarter of all jobs have gone to companies less than 20 employees. Now, those numbers were like 33 and 24% before the recession or before COVID. So that's a big jump up in the amount of people getting jobs in small companies. So you may say, wait a minute, Target or Walmart or McDonald's, because McDonald's is in the news, they're not going to employ people and pay them cash, because if they get busted by the Labor Department not withholding, that's a gigantic fine that they're going to pay. Yes, but people that employ less than 20 employees, small companies that employ less than 20 employees, think the corner restaurant, who's busting the tables, just if you wanted, they would and maybe are. And so there is a lot more employment in this country than the official numbers are showing. And that's why the consumption and the retail sales numbers are so strong, and the economy is staying strong. And even Jay Powell, that's why I found it to be very interesting. Powell said in his press conference in September, look, there's an increase in labor supply. There's millions of people coming over the border. They're working under the table. They're getting a lot of money because, they get a paycheck every week. Yes, Jay, you're right. And then he says, but we're worried about the labor market, so we're going to cut 50 basis points. Wait a minute, Jay. You just told me that there's a lot of people working. Now you're cutting. That's what was so confusing about that rate cut, because he acknowledged that part about the labor market, but then cut 50 anyway. And I think that was why you had that bad reaction in the bond market. Jay, you've just signaled to me you're going to cut a lot, and the market is trying to say we don't need it, because the labor market is a very different place post-COVID, largely because of remote work and a lot of other things, but also because of the change of the population in the country. The last thought on this, a lot of economic statistics that we look at, whether they're the payroll report, consumer confidence, ISM, the Institute of Supply Management, Purchasing Managers Report, these are all surveys. And the underlying assumption on any survey, even if it's a political survey, is we know the population of the country, we know the demographic breakdown of the country, and most importantly, we know where it's going to be in a year, 2 years, 5 years. We don't know what the population growth of the country, what the demographic is. It's very uncertain because of that huge influx of migration. We also don't know what the population growth of the country is going to be in the next 2 to 5 years. Is the orange man going to win, put up a border and deport 15 million people? That means a very different population growth of the country than if Harris wins and she leaves the border open and more people come into the country. Radically different population growths, which will produce radically different outcomes in our economic statistics. So I can, tell me who's going to win the election and then tell me what they're going to do, and I'll tell you what the population growth of the country is. What's surprising about that is up until 2020, this was never an issue. Demographers could tell you the population of the country is this. Next year, it's going to be that. In 5 years, it's going to be this. And they were reasonably accurate in all of those. But now it's a gigantic open question as to what it is and where it's going. And that is impacting so much of the data. And Jay acknowledged that, but then went ahead and cut 50 anyway.
Well, okay. So the bond market is like, we don't need this. So I imagine the bond market's also signaling that was a mistake. Why do you think they cut? Was that a mistake? Was it political?
That's the $64,000 question. I have been of the opinion that the Fed is political but not partisan. And what I mean by that, I got that from Claudia Sahm, give her credit for it. And I got that because not partisan means we don't sit around the big table in the conference room for the FOMC meeting going, orange man bad, how do we get him out of here? That would be partisan. But the Fed is very concerned about its reputation. It's very concerned about how it's being perceived by the rest of the country. And so they're very political. So I think what the 50 basis point cut was a political move that they didn't want to be perceived as not being attentive to the unhappiness in the country about the state of the economy. So we're going to cut 50 to show that we hear you, we're responding to it. I don't think they were being partisan, saying orange man bad and we got to get rid of him. Because if we assume that's what they mean, is that the Fed doesn't want Trump back in because Trump says mean things about the Fed and especially about Powell. And that's why they're against him versus Harris. They're against him because he says mean things about them. And then he scared the hell out of them a couple of months ago when he said, maybe I should be the Federal Reserve chairman. Trump wants to appoint himself, not only be president, but the chairman of the Federal Reserve at the same time. Good luck with that. Trying to get that through Congress. Because I don't think the Federal Reserve Act as it's currently written would allow it, but let's see if it actually comes to that. But so that's where I think that they came down, is that they were trying to be attentive to the argument that the economy was showing signs of weakness and there was broad unhappiness as the political polls were showing. But then they didn't realize that they were going to do it right on the precipice of a big upturn in the economic data. And now, yes, the bond market is saying, the bond market wasn't saying that 50 was a mistake. It's saying that 50 as a signal that you're going to go a lot more is the mistake. If you went 50 and you stopped, or you went 50, you stopped, you went 25, you stopped, that's not necessarily a mistake in the bond market's head. But if the answer is you went 50 and man, I'm rolling up my sleeves and I'm getting ready to go a lot more, that's what they're really worried is the mistake.
This episode is brought to you by Public.com. Public.com has just announced its new bond account, offering a 6.6% yield on your investment until 2028 when the first bond matures. Here's why it's interesting. Bond yields have been at their highest levels since 2009. However, the Fed just announced its first rate cut and more are on the table. In fact, current estimates from the CME FedWatch suggest rates may fall as low as 3% by the end of 2025. The good news, investing in a diverse portfolio of corporate and high-yield bonds could lock in today's historically high yields, even if the Fed cuts rates. That's why Public.com created the bond account. It's a new way to invest in bonds and earn a 6.6% yield on your investment for the next 4 to 5 years. Go to public.com/Julia to learn how to lock in a historically high yield on your portfolio. The bond account, only at public.com/Julia. All right. So on the economy, it seems to be doing just fine. I remember it was that 2 years ago, there was the Bloomberg headline, like 100% of the economists expected a recession. Obviously, that's not the base case anymore. But I want to hear a bit more where you stand on the economy. I remember, are you in the no landing camp?
I'm a no lander, baby.
Okay,
I am flying the plane at 35,000 feet, and we aren't going to 34,999.
I thought you might be in a no landing camp.
Yeah.
Can you explain that?
Yes. So remember that at the end of the day, at heart, everybody on Wall Street is a 12-year-old boy, and we all love airplanes. So we are going to use these stupid airplane metaphors,
That's
right?
all good.
Hard landing, soft landing, no landing. It's all about airplanes. Hard landing is recession. No landing. Let me go with no landing. No landing is if the economy's potential is that it could potential. What does potential mean? What do we expect the economy would do if no one's trying to stimulate it or slow it down? What's its natural growth rate? That's around 2.5%. GDP grows at 2.5%. That would be no landing, growing at around 2.5%. Hard landing would be somewhere below zero, and that's a recession. Soft landing is that wide gulf somewhere in between. It's not quite 2.5%, so it's not at its potential. It's a little bit less than that. So that's what the definitions of all of those words mean. So being in the no landing camp, I think that the economy is going to continue to grow at its potential. The concern I have is if the Fed thinks it needs stimulus and it's already at its potential, what's that stimulus going to do? Is it going to make it grow above potential? Probably. Well, is that a bad thing? No. Except, is there a consequence to growing above potential? Yes, and that's inflation. Because if there wasn't, if the fair argument is, well, there is no inflation, well, then stimulate it and grow it at 3 or 3.5 or 4. Because why would you stop it from growing at those? Why don't we want the economy to grow at 3 or 4%? Because we fear that at those levels, it would produce, so many people are making so much money that they start bidding on everything and prices go up, and that just creates more inflation. Bear in mind, the bottom half of the country is on fixed incomes. The bottom half of the country doesn't own stocks. They don't have assets. They don't own crypto. They don't own a home. So if prices go up because of the strong growth, they lose. And that's what you're seeing in the data. So 2.5%, yes. If we want to stimulate the economy to grow more than that, there has to be a consequence. Otherwise, do it. And that consequence is more inflation. And that's what the concern, I think, is in the bond market. You're going to stimulate too much. You're going to create more inflation. If you're going to create more inflation, that makes bonds unattractive. Their price goes down and the yield goes up. And that's why you've had such a bad reaction out of the bond market to the 50 basis point cut. Again, not because 50 was the mistake, but because the signal was you're getting ready to do a lot more. And that's what the mistake is. Okay.
So inflation is part of your outlook. That would cause bond prices to go down, yields go up. All right. I think the last time I want to say you thought the 10-year could go to 5. We could see the 5 on the year.
Okay. The 5.5 camp. Yeah.
I want to hear more on your outlook on bonds, and then maybe share with the folks what the implications are of that. If we see that resurgence in inflation, we see that movement in the bond market. Let's explore that.
Yeah. So 6 months ago, I was on the show. Yields were at around 450 to 460. And I said, look, I think they could go to 5.5. And they turned right around and went to 360. So I was completely wrong. I am a professional. Do not attempt this at home as far as these interest rate forecasts. Now that they've kind of gone back to 425 from 360 a month ago, yeah, I still think that the reason I said that they could go to 5 to 5.5 was the high of the move was October of last year at exactly 5% in the 10-year yield. And I was thinking, okay, I didn't think that was the end of the move. I think that there's still a higher yield than October of 2023 coming. So yeah, I'm still in that 5 to 5.5 camp. Just the timing has gotten pushed out a little bit more because the next move in bond yields was down to 360 by the middle of September. And the reason, again, is what I said. I think the economy is doing better than everybody thinks. I think that inflation is going to stay stickier, and you don't want to own a bond that yields 3% in that kind of growth rate world. You want to own a bond that has a bigger yield in that kind of growth rate world. And that's why I think that yields could destined to go up. What does it mean for asset markets like the stock market and everything? There is a level out there where higher rates seem to bother the stock market. I think that level is probably about 4.25, which is where we're at right now. In other words, up until this moment, the stock market has not been bothered by rates going from 360 to 425. But from this moment forward, if rates continue to go up, I think it will pose a headwind for the stock market. Now, why is it going to pose a headwind for the stock market? I'll give you a couple of thoughts. First of all, we have all become very accustomed in 23 and 24. We've had back-to-back good years in the stock market. It has returned 20+%, at least through this recording. Now, of course, we got 2.5 months to go and an election. Maybe by December 31st, it's far different. But for the moment, we've got another 20% year than as we had in 23. What should you expect the stock market to do from this moment over the next several years? If you look at Goldman Sachs, if you look at Dr. Jeremy Siegel from Wharton and Wisdom Tree, he's an advisor for the ETF company Wisdom Tree. Goldman Sachs has said something similar too. I'll put maybe about a 6 to 8% return per year is what you should expect from the stock market. If you get 20, you got more than what you should expect. Now, I know the problem with that statement is people are like, you mean 6 to 8% a month, right? Because that's kind of, everybody's been dead and they think that we're supposed to have these roaring kind of markets. Well, no, 6 to 8% a year. Well, if bond yields are going to push back towards 5, then a lot of people are going to say, you know what? If the stock market's supposed to give me 6, 7, but it contains a lot of risk, it could go down 20 or 30%. And bond yields are going to give me the vast majority of that with a lot less risk at this point. I mean, a bad year in the bond market might be a positive 1% gain instead of minus 20. Maybe I'll start shifting more of my money into the bond market and less of my money out of the stock market. Bond inflows in the bond ETFs have already set a record for a record year, and we still got 2 months to go. And it's already a record year. And that's why people are looking at bonds. All of a sudden, what's changed about the bond market is it is now, if you understand that 6, 7, 8% is what you should expect out of the stock market, not 20, then what you're looking at with the current yield in bonds is that is an investment that can compete with the stock market. This is not the 2019 bond market where its yield was well under 2%, zero on money market funds. And we used to talk about the 60-40 portfolio, 60% of your money in stocks, 40% of your money in bonds. And why did we put 40% of our money in bonds? That was crash insurance. The only reason you held that was it didn't yield you anything. But if the stock market crashed, the bond market was supposed to rally and offset those gains. That era is over. Now bonds can compete with stocks. They're like a lower beta stock. They don't return quite as much, but they have much less risk. So their risk profile compared to the stock's risk profile is very similar. And that's why you're seeing a lot of money going into the bond market. So as yields go up from above 425, my guess is more and more people are going to go, you know what? I'll take that higher yield and sleep at night. And, then to worry about whether or not the stock market's overdone over the last couple of years and is getting ready for a big correction. And maybe the election's going to be a problem or something like that. So if yields continue above 425, I think it's a problem for the bond market. I mean, it's a problem for the stock market.
Yeah. I think we talked about this too. Like the last time was, you could see that. I could see that happening probably maybe more with the boomers as well, who are, increasingly retiring, and maybe they're in their years of like, okay, I need to make this last for, X number of, decades left, that kind of thing. I wonder, like from a demographic perspective.
No, that's exactly right. I mean, I've often said that a bear market is time, not price. Because look, I know a lot of people that are listening to us, this podcast, are more younger, and you might be thinking,
actually, Jim, I got to tell you, we're very popular with the boomers on our audience. Yeah, Gen X and the boomers. Yeah.
Okay. So, but if you are younger, let me put it that way, You might say, you know what, bring on a 30 or 50% correction because I'll buy the hell out of it at much lower prices. And then in 10 or 15 years, when everything gets sorted out and we're on our way, here I go, and I'll make a lot of money. Okay, that's true. But who holds the wealth in the country? It's always old people that hold the wealth in the country. It's boomers. And in 30 years, it will be millennials that own the majority of the wealth in the country when they're all in their 60s. So if you're in your 60s and somebody says to you, look, the stock market might be overdone, it might correct, it might chop around for 10 years and not do anything. When was the last time that happened? 2000 to 2013. It went 13 years without making a new high. So it's not that far in the past. It was just 11 years ago that happened. You might say, well, look, I'm 64 years old. And if you're telling me that the next 11 years, there's the potential that my wealth today might be the same as my wealth when I'm 75 because I got to wait throughout this. That's more than half my life expectancy. I don't have that much time. If I'm 40 and you tell me that by the time I'm 50, I will have been able to buy much lower prices and I'll get ready for another big 20-year run in the stock market. Yeah, man, bring it on. So yes, a bear market is about time. It's not about price. And since a lot of older people that don't have 30 or 40 years left to invest, they'll look at the bond market and go, yeah, churn me out 4 or 5% every year. Thank you very much. I'll take that as opposed to the risk in the stock market. And that's why if you look at like target date funds, these are these funds like Vanguard offers where it puts a certain percentage in stocks and bonds. As you're younger, it's more in stocks. And as you get older and older and older, the bond in portion, the stable income in portion increases. And again, this is all because who owns all the money in the world? It's always going to be people over 60. In 30 years, it will still be people over 60 have all the money. They'll just be, the Gen Y or the Gen Y or the Gen Zs will be ranking on those useless old millennials that are getting in the way when they're in their 60s, like we rank on the boomers right now.
Let me bring up the election again with you. From where you sit or what you're looking at, I take it polls, betting markets as well. Is it 50-50 for you, or do you have some people have been on the show and they say they think it's 75% Trump, 25 Harris. I don't know. I don't know what your exact prediction is, but let's talk about that and maybe some of the outcomes, the scenarios. How do you think about what the implications might be for the economy, for markets, if it goes either way?
So I put out a tweet thread last night, and all I said in the tweet thread is, I do not think that the betting markets are manipulated. I would argue to you that they are trading at appropriate levels, given what we understand about the polls, the trends, and the narratives that are unfolding in the market. And that is that Trump is trading at somewhere at around, I'm looking
right now, 62 on Polymarket.
About 57 on predicted, maybe on Kalshi around 58. So high 50s, low 60s. Let me put that number in perspective. That is a probability, is what that is. So whenever you hear people say Trump's trading 20 points, 60, 40, better than Harris, you don't understand probabilities. That's a way to say you don't understand the entropy of probabilities. Anything between 40 and 60 is a toss-up. I've tried to put this in football terms because it's football season. And I've said, look, if Trump is trading under 66, he is leading the game. It's late in the fourth quarter, and he's leading the game by less than a field goal, less than 3 points. So if Harris gets the ball back and kicks a field goal, she wins the game. If he's trading more than 66, he's leading the game by more than a field goal. So if Harris gets the ball back, she has to score a touchdown. It's a little harder, but still doable. If he's leading by more than 80, he's leading by more than 2 touchdowns. And then Harris has to score twice. Very hard to do at that point. So by being in the 50s, low 60s, he is leading. He is ahead, but not by a lot. And also, he has been in an uptrend. He was under 50% 2 weeks ago. He was in the low 40s 6 weeks ago. So he has been uptrending, which is why he's trading a little bit ahead of the Nate Silvers and the 538s. They have betting models that have it anywhere, depending on, Economist Magazine has one, anywhere between about 52 and 56% is what they've got Trump at. And the betting market has them at around 57 to 62%, a little bit above the models. Why? Because Trump's been in an uptrend and they're anticipating it. So what I'm trying to say is I think the betting markets are not manipulated. I've been, by the way, just as an aside, I first started playing in the betting markets in 1992 with the Iowa political stock market. And I've been following these markets for a long time. And it's always the losing side that complains that they're manipulated. They were screaming, Republicans were screaming they were manipulated 4 years ago. In 2012, they were screaming that Romney was being manipulated and that he was actually leading. And it's always the losing side that screams manipulation. So this is nothing new about these markets. So that's where I'd put this election. It's a slight Trump lead. I would rather be leading than not leading late in the fourth quarter, to stick with my football analogy. But it is a slight Trump lead, but it's not insurmountable that Harris couldn't turn it around. The problem she has is I could have said that 2 weeks ago. I could have said that last week. There's only 12 days left. It's not being turned around. Now there's 12 days left. And so, can it be turned around? Yes, but it better start being turned around like later today or tomorrow. Otherwise, you're going to start running out of time here as well. And so therein lies the problem. Now, what does it mean for the economy? Neither one of them is talking about the deficit. That is, in fact, I've watched some political podcasts where the question is, why does anybody talk about the deficit? And they were very blunt. These are Washington thinkers. Doesn't matter. Nobody cares. And they're right. No one cares about it yet. But someday they will start to care about it. So from a deficit standpoint, it doesn't matter. If she wins, there's going to be a lot of spending and a big deficit. If he wins, there's going to be a lot of tax cuts. There's going to be a big deficit. If he wins, there's a potential tariffs. Tariffs that's inflation. That is taking the price of a good that is imported and making it more expensive by putting a tax. A tariff is a tax by putting a tax on it. So there's the potential of more inflation there as well too. So this is part of the reason why I also think that the market is saying, Jay, we don't need rate cuts. We got stimulus coming in the form of deficit spending or more deficits through tax cuts, which tax cuts are stimulus through Trump victory, or just more spending through a Harris victory. So, Jay, we don't need you to be cutting rates on top of it. So he's leading. He's leading not by much. You could look at it, if you're a football fan like me, you could say, look, I've watched lots of games when there's 4 minutes left in the game. My team's down by 2. If we could just get the ball back and kick a field goal. Yeah, but we can't get the ball back and we're running out of time here. And that's kind of where she is right now. So it's not insurmountable that she can't turn it around, but he is definitely leading in this election.
Mm-hmm. And then one of the takeaways I'm hearing too is regardless, inflation is still the base case, more inflation, regardless of the outcome.
Because MIT did a study and they said, they looked at the economic variables that drive inflation since 2022. And they came up with the largest economic variable that drives inflation is government spending. Mm-hmm. It's 40% of the reason we have inflation. If she wins, we get government spending, and that means more inflation. If he wins, we get tariffs. Tariffs are a tax which increases the price. That's inflationary. If he wins, we get tax cuts. That stimulates the economy. Remember I said about growing at 2.5%? What happens if we grow at 3 or higher? There has to be a consequence. Otherwise, we wouldn't hold the economy to growing at 2.5%. That would be more inflation. So yes, that's where I think the bond market is. And that's why, like I said, my theme here to you and to everybody listening is the market is saying, Jay, we don't need it. Why are you giving it to us? All these tax cuts. All these rate cuts, excuse me.
What do you make of just the way we've seen inflation, at least the rate of inflation, come down? Just want to hear more of your thoughts there. Prices are still more expensive than they were back in 2020. So I guess the rates come down, but prices are still high.
Axios has a famous graph that they put out earlier this year, and it shows the year-over-year change in the inflation rate. It went up to 9%, in 22, and then it comes back down. And they said, this is what economists see. And then they have another chart next to it, and it shows the cumulative prices rise, just keep going up and up and up. And they said, this is what normies see. And normies just see the cumulative rise in prices. And this even got, Biden's Twitter account, we know he doesn't run it, whichever intern runs his Twitter account, tweeted out the prices fell from the rate of inflation fell from 9% to 3%. Why haven't companies cut their prices? Because they're still going up. That's why.
Yeah,
they're
the
just
rate.
going up by a smaller amount,
Yeah.
meaning that there's this disconnect in how people understand a lot of this stuff. That just because a price goes up 4% one year and then goes up 3% the next year doesn't mean that it fell. It's just the rate of increase decline. So normies see the cumulative increase in prices, and that's why they're very unhappy, you see in the polls, and economists see the dip. Well, the problem with the dip and the year-over-year change is that if you look at core inflation, it still is not under 3%. It's at 3.2 on core CPI. Prior to 2020, if you told any economist 3.2% core inflation, absolutely unacceptable. That is way too high. But today we're saying 3.2%, mission accomplished. I'm like, wait a minute, we're not under 3, and the mission is supposed to be 2. And it's slowed down the decline in the rate, in inflation went from rising 3.6 to 3.4 to 3.2. And now it's kind of stalling here at these levels. And so I don't think that we've accomplished this mission with inflation like everybody thinks it has. I think we've come down. I've been in the camp that the inflation rate is going to be 3 something. It's not going to be 8, 10 or Zimbabwe. Got the 9% in 22, but 3% is a problem because that means that we're stuck in a 4 or 5 or maybe even higher interest rate world. And I talked about if rates get above 4.25, they can compete with stocks, and that could suck some of the life out of the stock market. Well, 3% inflation is the base that gets you to that 4 or 5% interest rate world. And that's a far different world than a 2% inflation world. So yeah, it's come down, but I think it's stalling a little bit. On the headline number, it's down to 2.3. But the reason the headline number is down so much is that it has fallen quite a bit because of the decline in gasoline prices, which crude oil prices are down to like around $25 or $30 over the last year. But a lot of that's because of weakness out of China. China consumes more barrels of crude oil a day than the United States. The Chinese economy has not been in a good place. How do we know that? Because the Chinese government hit the panic button a month ago and announced all this stimulus. They're trying to stimulate their economy. Okay, great for China. What's it mean for us? It means that if they're successful, they're going to consume more barrels of oil. They're going to consume more commodities, and so when they build an iPhone, we're going to have to compete with 1 billion Chinese to buy the iPhone, not just us. And those prices might start going back up again.
It's interesting you point out like the 3%, maybe that's more like going to be the new normal, but that is a far different world. Can you just help us understand? Because a lot of us have still been in that mindset of the 2%, right? What are the implications, maybe some that we're not thinking about in a 3% world? What does that mean?
So, in a 3% world, any investment that you put your money into needs to give you at least a 3% real return. Now, what does that 3% real mean? It means 3% after inflation. Well, if stocks are going to give you 6, 7, or 8%, what does that mean? That means that of that 6, 7, or 8, 3 of that is inflation. Inflation pushes up everything, including stock prices, 3%. It pushes up. So yeah, you make 3% more because of inflation on your stock portfolio, but you have to spend 3% more at the store anyway. So that's an offset. So then all of a sudden now the real return in the stock market looks like if I buy stocks after I account for inflation, I might be making 3, 4, or 5% in the stock market. Now, when you start looking at it that way, and then you say, well, what's the risk in the stock market? Well, it could go down 30%, and it could go up 20%. Then you start adjusting for the risk. You start going, man, that might not be such a good deal anymore. But, unlike the deal that we had in the stock market, say in 2019, where the perception was it was more of like a 7 or 8% stock market world, and you had less than 2% inflation, it was giving you 5 or 6% real. That's almost a doubling of the real rate. And over a period of 10 or 20 years, those two scenarios make a big difference in the amount of real wealth that you have, real wealth. yes, if my stock portfolio goes up 3% every year and prices go up 3% every year, I'm not making any headway. I'm just covering the increase in prices. I need to go up more than the inflation rate to make real wealth. And so it changes those real wealth calculations quite a bit. So I know people that are not steeped in this might look at this and we get blunted because the stock market's up 20%, gold's up 30%. These are unusual times that we're in right now. And we start thinking 3%, 4%, that's kind of like rounding error kind of stuff. I mean, crypto goes up and down 8% a week. That sounds like rounding error kind of stuff. But over longer periods of time, it does matter, and it does matter quite a bit. And I think the takeaway on that is if the stock market's longer term return, according to like Jeremy Siegel, Goldman Sachs, and I have no reason to believe they're wrong on it, is like 6, 7, 8%, and we're stuck in a 3% inflation world, yeah, the stock market is going to give you, it's going to be a wealth creation machine. It's going to give you more than the inflation rate, but not a lot more than the inflation rate. And you might be seeing that in the way that people are investing in the stock market. They're kind of sensing it out. Why? Why? Because we're chasing 7 stocks. We're chasing the AI stocks. We're chasing the Mag 7s of the world. That's what we're trying to chase right now. We're not chasing the entire stock market. People are even starting to think about, do I need to be investing in the S&P 500 or do I need to be investing in AI stocks? Do I need to be investing in crypto? Do I need to be investing in things that have a higher expected return than just 3%? So that's where I think it matters.
Yeah. I have to say, Jim, I always love having you on. I don't want to wait another 6 months, so we'll have to get you in the next 3, like maybe a bit of more of a quarterly check-in with you because you are just an absolute delight to talk to. I love listening to you. Learning from you always get me thinking. So can you just take the final few minutes, let folks know where they can, find more of your work, tell them about Bianco Research. I know you have an ETF as well. Any parting thoughts? The floor is all yours.
BiancoResearch.com is our website. I'm active at Bianco Research, both on YouTube. We have a YouTube channel and on Twitter. And I'm active under Jim Bianco on LinkedIn. We provide 2 businesses. Bianco Research is an institutional business. It's a business that we provide macro and fixed income research to institutional investors. And I dabble in a lot of other things like crypto and betting markets and stuff like that, because that falls under the rubric of macro as far as I'm concerned. And so it's an institutional business, and that means it's a pricey institutional product. But I put a lot of that up on social media as well, too. I've been in the bond market now for well over 30 years. We also have an ETF. We actually manage an index called the Bianco Fixed Income Total Return Index. So it's a subjectively managed index by us. It has its own website. It's called BiancoAdvisors.com. And the ticker symbol for the ETF that tracks our index is WTBN. Wisdom Tree is my partner in that. So that's the WT. BN is the Bianco Fund. So a WT Whiskey Tango Bravo Nancy. WTBN is the ticker for the ETF that tracks our index, which you can find out more about on Bianco Advisors.
I love it. Well, Jim Bianco, founder and president of Bianco Research, thank you again for being so generous with your time, your knowledge, all of your wisdom and insights. We appreciate you. And until next time, be well.
Thank you. You too.